Very good afternoon, everyone. Welcome to today's uLaw webinar. The topic for today's webinar is Law Society Bookkeeping Compliance. And today's webinar has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. So I kindly do repeat that today's webinar is accredited for 1 hour of professionalism credits in the provinces of Ontario, British Columbia, and New Brunswick. And the title for today's webinar is Law Society Bookkeeping Compliance. That's the title that you would use to enter into your respective Law Society portals. Please do use the chat window at any given time to answer any specific questions that you may have. And if it can be with regards to today's topic, that will be greatly appreciated. Like every other uLaw webinar, today's webinar has a specific agenda. We're exclusively going to focus our attention on the bookkeeping compliance requirements across law societies across Canada. We've kind of encompassed some of the salient highlights of these bookkeeping compliance, more to touch with the financial aspects of the compliance. As you can appreciate, there are other components of the compliance requirements with regards to client intake, matter management, and others. This particular session would focus on the accounting, the financial requirements, if you will, of the compliance. Starting with, of course, the trust and general ledgers. We'll talk about the ledgers, the journals, the format, and the pieces of information that is expected to be collected across these documents, and the underlying fundamental step that you have to take, which is the reconciliation process across the accounts that you have for your business. If you have a trust account and a general account, the expectation is to be able to reconcile both accounts. Of course, there's a lot more of importance that's provided for trust reconciliation, but we certainly believe with the right tools, with the right discipline, general reconciliation should be a breeze and should also enable you and empower you with the right data to make business decisions, as it does touch not only the compliance component of the law society. Reconciling your general account, of course, validates the P&L for that specific time period. And then we'll certainly look at other such documents that are requested potentially during an audit, such as the fee book, and certain jurisdictional documents such as Form 9A, deposit slips, and kind of going over as to how the data that you enter in your day-to-day bookkeeping system, whether it's a manual system or whether it's an automated legal accounting software, how should you be able to take that piece of information, convert them into these corresponding documents that become the importance of your bookkeeping compliance. Okay. And towards the probably the last 10 to 15 minutes of the webinar, I'll try and focus by using the uLawPractice platform just as an example to walk you through how compliance is dealt with, what you should expect out of the legal accounting softwares, and of course, giving you a perspective of how data is converted into these ledgers and journals. Okay. We've done these webinar sessions previously, and we try and provide additional information, of course, every time we repeat, but while keeping it within the context of the essence of the webinar. And we wanted to spend just maybe 2 minutes to walk you through the kind of options that you have today and the options that there were in the past to be able to accomplish this. So legal accounting, compliance, bookkeeping compliances, of course, that has been something that has been put across as requirements to legal professionals over several years now, right? But the advent of technology as a legal personnel, that the advantages, let's say, that you have as a legal professional today due to the advancements in the legal tech, like anything else in life, should empower you, should give you more efficiencies, should make you enabled to deliver these same requirements in a much lesser time by using the opportunities that you have, such as legal accounting software or other softwares, systems of record that can help automate these tasks. But in the past, when such technologies were not available, of course, you had a manual double entry system where people used to write it in notebooks, and then it evolved into a one-write system, which is slightly simpler, but it was time-consuming, especially if you're a legal firm leading with a lot of transactions in a month or a week. Moving on to the first level of automation, which was using spreadsheet software, which was certainly inexpensive, came through a package, definitely provided with certain automatic calculations to reduce any human error. But once again, time-consuming. You had to write the formulas for these calculations and automations yourself, needed a bit of training. Evolved from that to a general accounting software that evolved from just automation of formula to introducing certain level of subledgering, producing documentation such as reports that are important for your financial obligations, but still was not designed specific for managing some of the legal accounting needs such as trust management, which is a very important vehicle that I believe legal professionals have the opportunity and the advantage to use as part of their business and running their business. And from that has evolved the legal accounting softwares of the world that has been in business for the past, some of the softwares have been in business for several decades, and more commonly cloud-based legal accounting software have been in business for a few years now. And with each evolution of products gives you this new vehicle as a legal professional to automate, be more efficient, reduce human errors, and be very confident and stress-free regarding your reconciliation, ledger journal generations, and overall with regards to the Law Society's audits and requirements. Okay? Just for you to keep in mind, the requirements for these documents, the content in these documents have certainly evolved but have not changed drastically for these years. How do you, as the lawyer or paralegal, approach the capture of data and representing that data in that required document that has not necessarily changed? Now that has changed. So you now have the opportunity to either consider a manual system that you use today or consider a more automated software or automated approach to reduce the time and effort that you can put towards these things and focus that time towards maybe revenue generating tasks, maybe marketing, being out there to spread the word about your legal firm. So that's really what this is about. And also being consistent through the use of automation. Now let's focus on what's required across these documents. We'll first start with the ledgers, the pieces of information that you're required to capture. Even if you're doing this on a manual basis, this should help you put together a framework of how you capture data and how you report it. And then we'll focus on the journals, and then so on and so forth. We'll move forward with the reconciliation process in itself and the other documents that we discussed in the agenda. Now, for legal firms that does entertain the use of a trust account, where you do accept retainers, or maybe you're in the business of doing real estate where you do need a trust account, it is very important that you capture certain very important pieces of information regarding the transactions that touch your bank. So if someone's giving you a retainer, so money in advance, now you're accepting that in real life, you're providing that client a retainer receipt, you're taking that check or cash that they've provided you, and now you're depositing it in real life, let's say into a bank account. Considering that to be a real life financial transaction, it's now important that you capture that information. And why it's important to capture that information is because there's a time sensitivity towards that transaction. Because in the document, such as the ledger, the expectation is that you capture the date when such transaction actually happened in real life. So when did that customer of yours pay you that retainer? And when did you, as a legal professional, deposit that into the appropriate trust account? There are certain rules, boundaries that govern the type of transactions and the type of payments too. As you probably understand and realize already, if you have received, let's say, a cash retainer, you certainly have now 24 hours before you can take that money and deposit it into your trust account. So if it has been further than that, then that certainly would raise a flag during your audit. So it's important that you have the right tools, techniques to capture the data and also act based on the type of transaction that it is. When it comes to retainers, again, the boundary is around how much of a retainer can I take through cash. A general thumb rule, I think it's a policy, especially in Ontario, that you can take up to $7,500 in cash retainer, not more than that. Given that there are certain boundaries and restrictions around these financial transactions, the ledgers are a way for you to tell the story to these auditors for transactions that have, of course, happened over 12 to 18 months in a single discussion or a meeting that they have with you. And these documents, the ledgers and journals, are formatted in such a way that by reviewing those documents, the auditor has a better appreciation for the journey of those transactions in your legal business life. So by looking at the date, ensuring that there's a reconciliation statement for each month at a minimum for the time period that you've progressed before that audit, gives the auditor the confidence that you actually have a process in place to meet the requirements of the Law Society audit, and you're very much in line with the bookkeeping guidelines requirements of your law firm. Now when you look at the details that are expected in a ledger, here is a good example that's been taken out of the bookkeeping guidelines of the Law Society of Ontario, for example, and it's been consistent across the other provinces too. The information that they're asking for pertains to not just the overall firm. They require it over a time period broken down by the customers that were dealt with. Particulars such as the date, very important. What was this particular transaction for? So was it a retainer? Was it a settlement payment? Was it money, other payments into trust from a real estate transaction? What was the reason for this particular amount to enter the trust account? That's the second question. When did that amount enter the trust account? What was it for? And of course, did that money enter the trust account or did that money leave the trust account? When that money did enter the trust account, what was the balance in that particular client's trust listing, if you will? And of course, there's a running balance based on the amount of money that's gone in, the money that's been taken out of that trust account pertaining to each client matter. So if you have multiple matters with the same client, it would be categorized for each matter. So if you have a client, John Doe, and if you have a small claims matter as well as a separation, you would have a separate categorical ledger for the small claims matter with its own running balance, and would have a separate categorical ledger for the separation matter with its own financial transactions and with its own particulars and its own running balance. Okay, so this is important Sometimes when you have a manual system, you may be tempted to combine these two. One thing to keep in mind is to separate them out based on the file and the matter. So when you capture data, whichever system that you currently use, any system of record that you currently use, please keep in mind that as a trust ledger, the important components are the date of the transaction, what was it for, was it money coming in or money leaving, and what was the running balance as per that date. Okay, so that's a typical trust ledger, and I can see some of the participants wanting to present. I would appreciate if you just request to join. Now let's move on to a contrast with a general ledger. So let's say you're a law firm. You could have a trust account. Of course, then you have a general account. Some firms may not have a trust account, they only have a general account. It applies to both. Within a general ledger, you certainly have the same component of the date. So when did that transaction occur? What was the reason? Under particulars, was this particular transaction that came in or left, especially if it is left, is it an expense? And the reason for that is within a general account, typically if a law firm uses the general account to pay for its expenses, you have now paid on behalf of the client ahead of time, and you're hoping to recover it through either a trust transfer or acceptance of a client payment. And hence, the Law Society, in a way, wants to remind you of the expenses that you have incurred for that particular matter, and this document for your own consumption will help you recognize that recoverable expense. Then comes the fees, which is how much of money did you collect, what was the reason for the money coming in, of course, and if there are any jurisdictional taxes involved that you have collected from the client. Leaving you with the total payments and a balance owed, which is really nothing but an outstanding balance for that particular day. So now you can see there's some additional details, let's put it that way, between the trust and general. And the general, you have, of course, the additional expense column and the additional splitting of the fees prior to tax and the total, which is a combination of the fees plus the tax. Okay? And of course, the running balance remains to be the same. Once again, when you capture details about a payment, especially if you're using a manual system, if someone pays you, let's say you've done a matter, you've completed the work, let's say there's no trust involved, you charge them $565, very important for you to write it down on a piece of paper or into that Excel sheet, or if you're using a legal accounting system, then it would do it for you. But if you're doing this on your own, if you're using a paper-based system, differentiate that $565, if applicable, as $500 as the fees and $65 as the applicable taxes that you're taking from the client, especially if you're in the province of Ontario. Right? If you're in the province of British Columbia, New Brunswick, then the jurisdictional taxes apply. So you would apply the GST, PST accordingly. And its reason for that is when you do have a HST account or a GST, PST account, that money that you've just received from the client, balanced with the actual HST, GST, PST that you've paid as a business, needs to be equated, and then you owe the government that HST amount or GST, PST amount, depending on whether you have taken more from the client or just paid more to, as part of expenses. Right? So it's important because that's really not your money. That's not your direct revenue. That's money that you, in a way, owe back to the government. So splitting that is important. Expenses are important because they're captured in a fee book as well. So if you're doing this in a manual way, keep a separate tab of all of the office expenses that you've incurred. All the disbursements that you've incurred on behalf of this client. Okay. All right. So that's really the ledger document. That's date, particulars, receipts, disbursements, balance. In the general ledger, date, particulars, expenses, if any, fees separate out with the HST, total, and a running balance. Okay, straightforward. I don't want to beat that same concept to death. Now, that's one document that tells the story. Now, the Law Society wants to understand a little bit more. They want to go deeper into that story. So it's more detail that's required. And hence, now they're asking you for a bit of proof. So give me receipts. And there's a separate document called journals that in a way gives you that proof. So in the first document, you talk about, oh, I received $40,000 into my trust account on the 30th of August. Where's the proof? What method was used to show me that actually $40,000 was the actual amount? Because once again, we're talking about opportunity for misappropriation because you're taking money in advance, especially when you're touching trust. And hence, the Law Society wants you to be more responsible, and hence the Law Society is asking you for more information as proof to show details around those financial transactions. Okay, so ledgers tell a story. It can be an overall summary. Journals go one step further to say, okay, you received that $40,000. How did you get it? So the same date. Who did you receive that money from? What was the purpose? So it could have been retainer, mortgage payment, whatever, right? The amount, of course. And an important column in the journal is the method. The date remains to be the same, the amount remains to be the same, and you can notice that there's no running balance because this is proof. So they're basically just saying, if you are telling me that you've got $40,000 into that trust account on August 30th, I just need to you need to tell me who paid you that, how did they pay you? Okay? So from a trust receipts journal, it's the date, the client or whoever paid, the purpose, the amount, and the method. Now, there's also what's called as a trust disbursement journal. Okay? This captures details very similar of that of the date, the method of payment. So you can clearly see you've got a check number 2. So sometimes it's very important that you can keep a copy, a photocopy or a picture of these checks that you receive from clients. Sometimes you may just take it and deposit into the bank, and then the bank might give you a receipt as well with a copy of that check. But sometimes it helps. Who do you pay that money? So if you're paying disbursements from the trust account, then of course you need to tell the Law Society this is money leaving your trust account, and hence who was it paid to? And the amount and the purpose. So there's receipt and disbursements. There's 2 types of journal documents. Likewise, there's a receipt and a disbursement journal for your general account. Okay? The columns remain to be the same. You've got the date. So very important, anytime any transaction occurs, always make sure you're marking the date when that transaction actually occurred. Who did you receive it from? The amount and the method. So you can see the difference is within a general receipt journal, they're not specifically requiring who the client or the purpose of funds were. They just want proof of how it occurred. and proof of the method through which it occurred. But if you focus your attention to the General Disbursements Journal, and this is very important because you as a law firm, of course, may have a lot of disbursements that are being paid off the general account. Now you're divvying it up by the date, the method, who was this particular item paid to, so why was this money leaving the general account? And it's very important that you capture here that within a general disbursement journal, and this is very important, you're not only capturing disbursements, which are expenses, of course, around client expenses, so a court fee or an application fee, anything related to a matter that you are paying from your general account, that's a disbursement, a recoverable expense. But you may also have other types of expenses. As you can see here, some examples: rent, your law society fees, your errors and omission fees. And these may be items that you also pay out of your general account. Now, that needs to be captured as well, along with the amount, separating out the jurisdictional tax and total payment. So a ledger tells an overall summary. The journal that has both a receipt and disbursement. Receipt when you're getting the money in, disbursements when you're money leaving out the account for both trust and general. So let's take account. You have 1 trust ledger, 2 general ledger, 3 trust receipts journal, 4 trust disbursements journal, 5 general receipts journal, and 6 general disbursements journal. So far we have accounted for 6 documents that may be in play. If you have no trust account, no transactions in the trust account, of course, now it's going to reduce by that amount. It's just going to drastically reduce to 3. Okay? So these are probably the 2 important sets of documents that are expected, that you are expected as a law firm to generate on a monthly basis. So for every month, you create the ledgers and journals for both the trust and the general accounts, how many other accounts that you may have. Now, what is the fundamentals behind these numbers? The fundamental behind these transactions is a process called as the reconciliation. Reconciliation is a step or a process that your legal firm or yourself would have to do by comparing the information that you've just saved into your manual system or legal accounting software or any software that you're using and matching it to another system that's in play that is a source of truth. In today's modern age, that source of truth is the financial system or institution that your firm is tied up with. Whether it's the top banks or credit union that you work with, anytime money enters, or let's say a client pays you a retainer, you take that check, you write it down into your bookkeeping system saying, hey, today on October 9th, I received this. But eventually you take that and you deposit it into a financial institution, the account that you have with that financial institution. So now the financial institution also has a record keeping of that transaction. Now, all that the reconciliation process is asking for you to do is just compare and match, saying, if you have recorded 565 as the retainer that you received on October 9th, just show me that the bank that you are dealing with can also prove that that transaction exists. Okay? Fundamentally, that's what the reconciliation process is. It's important from a law society standpoint. It's very important from your own bookkeeping standpoint as well. Because now you're truly validating, especially when you're doing a gender reconciliation. The trust reconciliation, of course, is for the law society. You're complying with it because for misappropriation and other aspects of the compliance needs, because you're not just faking. They want to make sure you're just not randomly saying you got $5,000 in your trust account, not being able to show a financial proof of it. But when you do a general reconciliation, which we find that law firms don't necessarily do, the general reconciliation actually allows you to validate and tell yourself the actual amount of revenue that you have received, the amount of money that's come in as revenue, the amount of money that's left, so receipts and disbursements in your general account. And let's say you have a running balance, that's that month's profitability, right? So let's say you got $5,000 and you spent $2,000. By validating that you actually have got $5,000 and spent $2,000 by validating against the bank, you can now confirm to yourself and to your law firm that $3,000 should be the profit for that month. Now, the reconciliation document that you generate, you have to do it once a month. And there's a certain format, again, part of that storytelling, because the auditors are going to come meet you every 12 to 18 months, or rather, in fact, let me put it this way. If you're a new law firm, it is anticipated that within the first 12 to 18 months, you will be audited. Of course, things may change with regards to our current COVID situation, but that's the last that we know. And of course, there's a cycle of audit requirements that are then notified to you as a law firm from the Law Society audit, from LSO or the Law Society of British Columbia, other provinces, Alberta, New Brunswick. But the storytelling around a trust reconciliation document has 4 important components to it. Just like how the ledgers and journals had a template, the reconciliation document also has a format and a template. Now, the 4 aspects of that trust reconciliation document start with a record keeping of the bank's statements and balances. So I'm going to try and be loud. The first step really is capturing the outstanding balance in your bank. So let's say you're reconciling at the end of the month for that particular month. So let's say for the last month that we just completed, September 29th or 30th, we want to capture what was the balance in the bank in the actual financial institution, let's just call it that, on that particular date, because that forms the basis. The second is capturing all of the outstanding checks and deposits and any bank errors. And these are the 3 important anomalies that you may come across when you try and match what's in your bookkeeping system against what's in the financial institution. Okay, so these are 3 areas: outstanding deposits, outstanding checks, and any bank errors. So for example, if you had a bank error in the trust, what that really means is sometimes, if you haven't explicitly mentioned it, sometimes financial institutions may charge you a bank fee and may, let's say, withdraw $10 automatically out of your trust account. Now, it's your responsibility as a law firm to go and tell the institution that your trust account needs to be untouched and any bank fees should be withdrawn from your general account. But let's say that fees was taken and you did not catch it early, and while you reconcile at the end of the month is when you suddenly see that $10 has been taken out of the bank in real life, whereas you have not yet accounted for it in your book, accounting system, then you need to be able to tell the auditor through this document by saying, as of the 29th of September, when I did the reconciliation, I recognized that, my book is $10 more because there was a $10 bank fee that was withdrawn from the bank. If you catch it early, and hence if you can reconcile on a more regular basis, then you probably can call the institution. They would put that $10 back and then go and withdraw that from your general account. So it kind of equate itself, so you don't really have to worry about it. Another anomaly is where someone, let's say a client, paid you a trust check. Now you took that check, you put it in your drawer, you entered it due diligently into your bookkeeping system, saying, I just got $1,000 into this as a retainer for this particular client. You've taken all of the notes. But for whatever reason, you totally forgot to deposit that check into the bank. It has happened. It's not something new. Sometimes when you're very busy, these things happen, and you've not realized it. Now, when you try and do this reconciliation process, what are you going to find is that your bookkeeping system says that you got $1,000, but there's no indication of that in your bank at all because you've not yet deposited that amount. So now when you compare your bookkeeping system and compare your bank, you're going to see that your bookkeeping system has $1,000 extra. And now what you have to do is take that check, deposit it into the bank, leave that transaction to come back and catch it the next month, or indicate that there was an outstanding deposit. And that's led to the $1,000 being extra in your bookkeeping system. So the auditor would want to know, right? Why was there $1,000 more in your books when that money is not showing in the bank? So you indicate saying, hey, if it's an outstanding deposit, I forgot, and that's totally fine. You at least know the reason why that difference exists. And the opposite is true too. Let's say you had a client payment, or let's say in the case of a trust transaction, you got that check, you due diligently took that $1,000 check and right away deposited it into the bank. And you went on a vacation maybe, or you totally forgot about it, and you did not keep a record within your bookkeeping system. Now, when you come back to the 29th of September, you're going to notice when you match the two records that the bank has one extra line item with $1,000 of a retainer, but you don't see that in your bookkeeping system. Now what you have to do is, of course, go back in time, enter that client information, enter that file for which the $1,000 was received. So now this is where you have to use your memory, and this is why catching it as and when it happens helps improve retention of that detail of that record, right? So you don't have to scratch your memory too much. Now you have to write that information into your bookkeeping system and saying, all right, I'm sorry, that was an outstanding check that I missed because it was already deposited in the bank, but I missed making a record of it. So these are very common anomalies between why there could be a difference between what you've captured in a bookkeeping system to what could have actually happened reflecting in your financial institution's record, right? And reflecting if such anomalies do exist in that time period is what this particular document mostly highlights. It's for your own safeguarding too. Step 3, of course, is a very important difference between a trust reconciliation statement and a general reconciliation statement, which is the client's trust listing. So many clients who have, of course, given you this retainer or money in advance for you to put into your trust account. This client's trust listing is a line-by-line item capturing each and every client of yours. Most importantly, the last activity date. So as of 29th of September, or what was the balance against that individual client? Okay, so if Peter Piper had given you $2,000 as of August or September 29th, 1,120 was the balance. So of course, to assume that the remaining 880 was either moved to general or is still sitting, or I guess that's the idea, is it has been moved, that has been already used. So that's the balance as of that particular date. And the fourth step in this trust reconciliation document is a final comparison. So this is the summarization that you're giving the auditor, saying, all right, now having gone through these checkpoints, using these anomalies, using them in play, giving you a trust listing, the total between what the bank says, and that's what's the total reconciled trust bank balance, and what your bookkeeping says is the total of unexpended balances as per your own client's trust ledger. The top is what the bank says. The bottom is what your book should say. And when they balance, that's a balanced reconciliation report. And you generate this on a monthly basis. Okay? I know I'm kind of going slow today, but I wanted to make sure that I get across the point. Let me quickly jump into, one important component is the general ledger, which we'll look into once we get into the system. One differentiator between the trust and the general, of course, is that in the general, you would not have the client's trust listing. You would still have the balance per bank statement. You would have any outstanding checks or deposits, and then you would have a final summary comparing the outstanding as per the bank from your general account and what your general ledger says. So this would just read client's general ledger. Okay? So you've got 2 reconciliation documents and 6 other documents that we originally discussed, including ledgers and journals, so a total of 8. This is not to overwhelm you, really, but to give you the facts of the matter of how each and every data transaction that enters your legal firm converts itself and finds a place in a document that tells the story of the journey of those transactions in your legal firm. Fee book. So this is yet another Law Society document that captures the invoices and the disbursements as raised in invoices. An invoice consists of fees and disbursements typically, so you want to be able to capture each and every line item of those invoices from a perspective of recoverability from your clients. Though disbursements is an expense, the fact that it's a recoverable expense, so at that particular time it was part of your invoice, it's still considered to be part of that fee book. And if you're doing this the manual way, then what you need to consider capturing and recording and being able to present it is the date when that invoice was generated, an invoice number for uniqueness, the client, and if possible, the matter too, for whom that invoice was generated, the total fees billed, once again, separating out jurisdictional taxes if you're actually asking for it, and any disbursements that were part of that invoice, giving you a total bill. So if you had $565 and a $100 application fee, this line item would read as date October 9th, invoice number, let's say 0001 for Peter Piper. Fees would be 500, disbursements would be 100, HST would be 65, the total would be 665, assuming that that's what is reflected in that invoice too. Okay? So this is number 9. Then comes certain jurisdictional documents that are more recent in nature that are being asked for. One of them being, and often we find it's being asked during audits, especially here in Ontario, I believe, is a Form 9A. If you've had cash deposits, so let's say you take a retainer and deposit it into the cash, there's no line item to say it was a check. There was no electronic means. So at the time of deposit for both retainer as well as important for general as well, it's important that you have deposit slips. So the financial institution would give you that slip, or you should request that slip when you deposit that cash into your account. So that's the proof that you did get that money. And an important aspect from your side to your client is to be able to provide a receipt for that cash, especially if it's a cash retainer or any cash payment. Very important that you provide a receipt to your client and accept a deposit slip from your financial institution for a proof during your reconciliation and audit purposes. A Form 9A, as you probably already know, is a document that captures information around the source and target financial institutions from where money is leaving your trust account through an electronic means. For example, if you're doing a trust transfer and money is leaving that trust account into, let's say, your general account, and if you're transferring that electronically, so you log into your TD Bank or RBC, CIBC, credit union online banking account, and let's say you just move this $565 worth of fees from the trust account into the general account by just transferring it electronically, then for each of those transactions, it's important that you have a Form 9A, which captures the source and targets. In this case, it could be TD to TD, the branch address where you're actually having an account opened, the amount that was actually transferred, so in this case, $565, and a reason for why that was transferred. In this case, this would be eligible trust transfer based on the invoice that was raised. So it's important that you mention the invoice number. And the Law Society expects you to actually sign this document, once again, showing that as proof and you validating and warranting that, yes, you are the one who actually did that electronic transfer and you vouch by the details provided in that Form 9A. Okay? So this could be document number 10, 11, on a very generic basis. So you have anywhere from 6 to 10 documents that you want to keep in mind as something that you generate on a monthly basis towards compliance, towards bookkeeping compliance and Law Society requirements. So with another 10 to 12 minutes left in the webinar, I'll maybe pause for a quick 1 or 2 minutes to ask the audience to use the chat window, because this is a CPD session, but I'd definitely like to be this more of an informative learning process. If there's something that you would like to ask either myself or my team with regards to the content covered so far, because after which I'm going to be moving on to walking you through an example using the uLaw system of how data converts into these documents. So I'll pause just for a quick minute to ask any questions that you may have during this time. Okay, I guess either I put you to sleep or I've been very straightforward with everything that I had to say. Now, knowing that this is the pieces of information that you are required to capture on a regular basis, the real question now is, how do you do it efficiently by saving time, energy, money, doing it right every time, seeing if you can automate these tasks, because these ledgers and journals are not changing every month. It's pretty much the same format. Data in, data out. So if you can find a method, especially if you're doing this a manual way, find a method to capture the data with all the particulars that are required for this audit requirement purposes. So capture the date, capture the particulars, capture the taxes, right? The question now becomes, as the 21st century legal professional that you are, how do you maximize the use of software or tools that can help automate these tasks? And there are tools out there, legal accounting systems most definitely being one of those tools that can give you that automation, reduce errors, and of course, once you've devised it to be automated using tools, then it's just a matter of practicing and using that tool every time. Now, whether you're using a manual system or a legal accounting software, one thing that we recommend that you do is always capture these financial events or transactions and write it down into a paper, write it down into an Excel sheet, write it down into your accounting software as and when it happens. Record all of the financial records and bank records pretty much as soon as it happens. This makes reconciliation easier, and the right tools allow you to even reconcile your statements on a daily basis, if not a weekly basis, if not once a month. Okay? Now let me quickly shift gears and let's take a quick example where we enter a client. We have a trust transaction to enter. And that's a financial transaction, and we'll find a way for you to make. Okay, that's a question. So anytime there's a real estate transaction, especially if you're paying it, you're probably using a third-party system to do all the disbursements, let's say, for example. Whatever expenses that you're incurring, it's important that you capture it in an invoice, and that invoice be generated for your client, and whatever amount of money that there is in that expense is what you recover, either as a general payment or as a transfer from trust to general. Okay? So typically a real estate transaction, for example, has a lot of disbursements because you have the land transfer tax, which is a pretty high amount. You have search fees, title search. You may have a lot of other disbursements like fax and quite a few disbursements that are involved in a real estate transaction. You capture all of those, make them a part of an invoice, and typically what happens is you accept a retainer or accept money in trust account when you ask for, let's say $500,000 was the worth of the home, and your legal fees is $1,000 plus disbursements. Typically I find lawyers or legal firms asking for the $500,000 purchase price plus a retainer, let's say $2,000. So it's $502,000, let's say. And then you take your legal fees and any disbursements, transfer that money over to your own account, transfer the $500,000 to the final end party, let's say Mattamy Homes or anyone else. And if, let's say, there's $300 left in the retainer as the balance, then you write a check back to the client as a refund of a retainer, for example. We find that often. Or if you know exactly how much of money is owed, you can ask for that. Or if your disbursements are extra and you do not account for it in your original money coming into your trust, then you send that invoice and get paid. So just to show you in terms of the transactions and how it makes its way into these documents, let's just quickly create a client. I'm just going to come up with a random name. And for purpose of today's demo, I'm going to skip the whole filling of information. I'm going to just save and create a matter. So I've just saved the contact, Ben Harvey, and let me go ahead and create a file or a matter. And let's just call this Wilson Estate. And just for purpose of this demo, let's assume we're taking a retainer. That's a financial transaction. So you're recording it into your bookkeeping system. You're saying, yes, I did get that retainer. So from a reporting standpoint, they do ask you for the date. So making sure you've got the date. Actually, let me put it for today. And let's say you're asking for taxes in Ontario for 1,000 plus taxes. You get it through a check. This is important from a journal perspective, which says, how did you get that money? Show me the proof. So it could have been a check, it could have been an email transfer. Had it been cashed, and of course, then you need deposit slip, which bank account was this deposited under in real life, so that when you're reconciling, this is the account that you're reconciling against. Who paid that? And of course, for your own client, providing them a receipt of $1,130, saying, hey, thank you very much. I've just got $1,130. I accepted into my system, and here is a retainer receipt confirming that I have. Now, that was a transaction. So if I go into my accounting system just for a sec, just to show you how you need to keep a balance of the information. And let's say you're reconciling. Here is that line item showing that on the 9th of October, the description being the retainer for Ben Harvey, you just got $1,001 or $1,130 deposited into your trust account, or that's what you've told your bookkeeping system. And this translates into a trust ledger as well, because that's now information that you've just written yourself, because that's all that they're asking. When the reconciliation happens, then you confirm towards the end of October to say, when did that $1,130 make its way? Maybe you forgot the check, right? When you do your trust ledger, which is one of the documents we spoke about, for Ben Harvey, we captured the date, the file number, very important, the matter, the particulars. So you've got the retainer, what was the reason for that particular transaction to occur, and it was received. So it's a receipt of $1,130, and no other transactions have occurred to reduce that amount, and hence on the 9th of October, that's the balance. Now, you continue down the path. Let's say there's a few more transactions that occur that's more not yet financially impacting. So let's go ahead and put a docket. Initial client meeting, this happens every day, and you're charging them, let's say, an hour. This could be a block fee, this could be a flat fee. Of course, this is Wilson Estate, so let's not kid ourselves here. I'm just going to say Will's matter is complete. And let me put in the description, let's say initial meeting, phone call, Will's draft. Document prepared, sealed, and delivered. Let's see if we completed the work. And you're going to charge a flat fee of $1,000. Okay. Now, of course, you need to relay this in an invoice. Just so I can combine both trust and general, let me also say that there is a disbursement. Not that there will be in this case, but I'm just making it up. So let's say there's a fax disbursement of an additional, I don't know, $100. That gives you a disbursement that's over and above the retainer that was provided. Let me go ahead and generate the invoice. Okay. And of course, in this case, you have the opportunity to do the trust transfer, because that's the eligible amount that you've earned. And then you've got an outstanding $130 for which you have to follow up with the client. Okay, so the simpler thing would be to move the money from the trust to general, right? I'll go ahead and do this. This is at your own. Now, this is a financial transaction that you're confirming within your system that is happening. So you write down a piece of paper, Excel sheet, accounting system. And if you do this electronically, you have now the Form 9A to download, which gives you the transaction ID, the trust and general accounts that were dealt with. So this is a typical Form 9A, which has all of the information, the amount, the client, the reason, tells you the fax invoice, legal fee, invoice number, etc. Okay. Let's say the client also paid you the additional $130. You take that payment. Let's say maybe they gave you a check. You put it into your general account, give them a receipt. And I do apologize for taking slightly longer, but I'm going to wrap up real quick. So now we have two transactions, trust-related and general. So now if I go back into my reconciliation for my trust account, before you noticed that there was just one line item. Now you're going to notice that there's two. Money came in, money left the trust account. Why did it leave? It left because of a trust transfer that you had done on the state using the legal fee 3295 as the reason. And where did it go? We're going to find out. Went into my general reconciliation. And then you're going to notice two transactions. 1,130 came in today for Mr. Ben Harvey through the trust transfer. In addition, $113 check payment was made for that same client for Ben Harvey. So when the time comes to reconcile, you're going to compare that with your bank, and it's just a very simple process. If you look at the trust general ledger, here are the remaining 8 to 10 documents that we were talking about. Let me generate this for the month of October, though it's not yet completed. The general ledger for the month. First show you the trust ledger. If you remember, the previous time we did Ben Harvey, that was just the retainer that was involved. But now you've got $1,017 remaining with a balance trust of $0. Okay, so 1,130 was taken away. And here is my general ledger for the same Ben Harvey. $1,130 was the legal fee, which included $1,000 plus the $130 in tax. So you've accounted for the provincial taxes that was received from the client. There was an additional disbursement of fax for $113. Now that was $100 plus the $13 of tax. And all of that was recovered, leaving your general at zero as well. And if you complete your reconciliation process, now you compared each of these line items, starting with the 5th of October till the 9th. Open the bank statement. First check if this transaction existed. If let's for some reason say it did not reflect in the bank on the 5th, you had recorded it on the 5th. The bank said it only came in on 7th, you change the bank date. That's all you do. Account for each of the transactions that have occurred in that particular month. Those two transactions that happened this afternoon. Tell us the bank statement. What was the balance on the 9th? Were there any outstanding withdrawals, outstanding deposits? We're going to assume nothing. There was no bank errors. And you're ready to reconcile. And when you do that, you of course have your trust reconciliation report, which is being generated at this time. And all other documents, your journals. So if I look at my journal trust receipt, remember we got that through a check or electronic means. The journal captures every piece of information that's required. So the bottom line is, as part of your compliance, the day-to-day financial transactions that touch your business are required to be converted into these storytelling ledgers and journals, ready for audit purposes. And by using the right tools and the right methods and process, you as a law firm can be ready to be compliant right from day one. And that's the whole purpose of this session. And once again, I confirm that today's webinar was accredited for 1 hour of professionalism CPD credits in the province of Ontario, British Columbia, and New Brunswick. And I thank everyone who's joined me today. It's being recorded, will be available on our YouTube channel early next week. So once again, thank you everyone. Have yourself a very wonderful long weekend. Take care.